Like a bar can be trend bar or a trading range bar, any segment of a chart can be classified as trending where either the bulls or the bears are dominant, or two-sided where both the bulls and the bears alternately assume relative control. When the market breaks out into a trend, there is usually a trend bar, which can be small or large, followed by many bars that are trending as the market spikes away from the trading range. One of the most important skills that a trader can develop is the ability to reliably distinguish between a successful and a failed breakout, a reversal. Will the breakout lead to a swing in the direction of the breakout or in the opposite direction? This is discussed in detail in the second book. In thinly traded markets, the breakout can appear as a gap rather than a trend bar, and that is why a trend bar should be thought of as a type of gap discussed in detail in book 2. At some point, the market begins to have a pullback and then the trends lows into a shallower slope and becomes more of a channel where a trend line and a trend channel line can be drawn. As the trend continues, the lines should be redrawn to contain the developing price action. Usually the slope becomes shallower and the channel becomes wider. Some form of this spike and channel behavior happens to some extent every day in all markets. The start of the channel usually becomes the start of an incipient trading range. For example, if there is a spike up, an upside breakout that lasts several bars, there will then be a pullback. Once the pullback ends and the trend resumes up, it usually does so in a channel rather than a nearly vertical spike, and there is usually more overlap of the bars, more small pullbacks, more bars with tails, and some bear trend bars. The bottom of the channel phase of the trend will usually be tested within a day or two. Once that pullback begins and the market 77, 78. Price action is moving down toward the start of the channel, traders will suspect that a trading range is forming, and they are right. Price action traders will anticipate that trading range as soon as the spike ends and the channel begins, and a few bears will begin scaling into shorts on that first pullback after the spike. Since they are confident that the low of the channel will soon be tested, they will scale in shorts on other pullbacks and above the highs of prior bars as the market continues up. Later in the channel, more bears will scale in above bars. Once the market turns down into a larger pullback that tests the bottom of the channel, they will exit all of their shorts with profits on later entries and at break-even on their first. Since many traders will cover their shorts around the bottom of the channel, they're buying along with bulls returning to buy where they bought earlier. At the bottom of that first pullback after the spike up will lift the market once again, and the trading range will broaden. After this bounce, the effect of the spike and channel has played out and traders will look for other patterns. Because channels usually get retraced eventually, it is helpful to look at all bull channels as bear flags and all bear channels as bull flags. However, if the trend is strong, the breakout may go sideways and be followed by more trending. Rarely, the breakout can be in the trend direction and the trend can accelerate sharply. For example, if there is a bull spike and then a bull channel, rarely the market will break out above the trend channel line and the bull trend will accelerate. Usually the breakout will fail within 5 bars or so and the market will then reverse. Although most trading ranges are flags on higher time frame charts, and most of them break out in the direction of the trend, almost all reversals begin as trading ranges, which will be discussed in the section on reversals in the third book. A test means that the market is returning to an area of support or resistance, like a trend line, a trend channel line, a measured move target, a prior swing high or low, a bull entry bar low or a bear entry bar high, a bull signal bar high or a bear signal bar low, or yesterday's high, low, close, or open. Traders often place trades based on the behavior at the test. For example, if the market had a high, a pullback, and then a rally back up to that high, the bulls want to see a strong breakout. If one appears to be developing, they might buy at one tick above the old high or they might wait for a pullback from the breakout and then buy it on a tick above the high of the prior bar, expecting a resumption of the breakout. The bears are looking for a reversal. If the rally up to the old high lacks momentum and then the market forms a reversal bar in the area of the old high, they will short below the reversal bar. They don't care if the test forms a higher high, a double top, or a lower high. They just want to see the market reject the prices in this area to validate their opinion that the market is too expensive up here. A reversal is a change from one type of behavior to an opposite type of behavior, but the term is most often used to describe a change from a bull trend to a bear trend or from a bear trend to a bull trend. However, trading range behavior is breakouts, trading ranges, tests, and reversals. 79. Arguably opposite to trending behavior, and when a trend is followed by a trading range, the market's behavior has reversed. When a trading range becomes a trend, the market's behavior has reversed as well, but that change is called a breakout. Noon calls it a reversal, although it is technically reversing two-sided trading into one-sided trading. Even though most traders think that a reversal is from a bull trend to a bear trend or a bear trend to a bull trend, most reversals fail to lead to an opposite trend and instead become a temporary transition from a bull or bear trend into a trading range. Markets have inertia and are very resistant to change. When there is a strong bull trend, it will resist change. Almost every attempt at a reversal will end up as a bull flag, and the trend will then resume. Each successive bull flag will tend to get larger as the bulls become more concerned with taking profits and less interested in buying heavily, and the bears will start becoming increasingly aggressive. At some point, the bears will overwhelm the bulls, the trading range will break to the downside, and a bear trend will begin. However, this usually happens after several earlier reversal attempts resulted in increasingly larger bull flags where the bulls overpowered the bears and a bear trend failed to develop. Even though most reversals simply lead to trading ranges, the move is usually large enough to result in a swing trade, which is a large enough move to create a substantial profit. Even if an opposite trend eventually unfolds, traders will take at least partial profits at the first reasonable targets, just in case the reversal only leads to a trading range, which is usually the case. Reversals have different appearances, depending on the chart that you are using. For example, if you see a large bear reversal bar on a monthly chart, it might be a 2-bar reversal on a weekly chart, and it might be a 3-bar bull spike, which is a buy climax, and then a 10-day trading range, and finally a 2-bar bear breakout on the daily chart. It does not matter what chart you are using as long as you recognize the pattern as a reversal, and all of these patterns are reversal patterns. 80. Price action. Figure 3.1. Figure 3.1 breakouts, trading ranges, and tests. The 5-minute mini chart in Figure 3.1 shows examples of breakouts, trading ranges, and tests. Every swing is a test of something, even though most traders don't see what is being tested. Many of the tests are related to price action on other time frames and other types of charts, and include tests of different types of moving averages, bands, Fibonacci levels, pivots, and countless other things. The market tested yesterday's low, but the breakout failed and formed a lower low as it reversed up sharply in a spike up to bar 4. Every breakout, whether it is successful or fails, is eventually followed by a trading range, as it was here. A failed breakout to a new low indicates that the bulls and the bears agree that the price is too low. The bears will take profits and not sell very much at these low prices, and the bulls will continue to buy aggressively until both believe that the market has reached a new area of equilibrium, which is a trading range. Bar 1 was the signal bar for the sell-off on the open, and the market should not have been able to go above its high if the bears were still in control. Bar 4 was a higher high test of the bar 1 high, and the upward momentum was so strong that the market would likely test up at least one more time before the bulls would give up. The double tops and bottoms are rarely exact, resulted in only a 1-bar pullback before the breakout above bar 1 succeeded. Bar 5 tested the high of the bar 2 signal bar and formed a higher low. Figure 3.1 breakouts, TRADINGRANGES, tests, ANDREVERSALS 81. Every sharp move and every strong reversal should be thought of as a breakout of something. It does not matter if you view this sharp move up from bar 2 as a breakout above the small bear trend line drawn from bar 1 or as a breakout above the bar 2 reversal bar. What does matter is that during this spike, the market agreed that the price was too low and it was trending quickly to find an area where both the bulls and the bears were comfortable placing trades. This resulted in a channel up from bars 5 to 6, and within the channel, there were many bars that overlapped with the bar before or after. This overlap of bars represents a hesitation by the bulls where the market was now able to trade down for a few ticks and a few minutes before moving higher. Some bulls were taking profits as the market was working higher, and bears were beginning to short. Many were adding to their shorts, scaling in as the market went up, just as many bulls were taking more and more off, scaling out. This channel is a weaker bull move, and channels are usually the start of a trading range. As you can see, the market retraced back to around the start of the channel by bar 7. Bar 7 was a higher low test of the bar 5 swing low and a second test of yesterday's low, and the market reversed up in a double bottom. Bar 8 was a lower high test of the bar 6 high and of yesterday's close, and formed a double top instead of a breakout. It also tested the high of the bear inside bar that followed bar 6, and that bar was the signal bar for the sell-off that followed. The reversal down to bar 9 tested the moving average and became simply a pullback from the breakout attempt. It was followed by a successful breakout to a new high of the day. Bar 9 also tested the long entry above the bull bar that followed bar 7, and it missed the break-even stop by a tick. When the bulls are able to prevent the break-even stop from being hit, they are strong and a new high usually follows. Deeper discussion of this chart. When a chart discussion runs for multiple pages, remember that you can go to the John Wiley & Sons website wiley.com/go/tradingtrendsandythivithet to print it out, allowing you to read the description in the book without having to repeatedly flip pages back to see the chart. In figure 3.1, bar 3 was a large bull trend bar that was the start of a bull trend, and it should be thought of as a breakout and a breakout gap. The market broke below the bull channel into yesterday's close, and a bull channel is a bear flag. The breakout had some follow-through, but there were bull bodies and overlapping bars, indicating that the bulls were active. The market then broke out below yesterday's swing low, and the breakout failed and became the low of the day. If you did not buy the bar 2 reversal up from yesterday's low, the bar 3 strong bull trend bar showed you that the always in position was up and you should look to buy either at the market or above the bar 5 pullback. Always in is discussed in detail in the third. 82. Price action. Figure 3.1. But it basically means that if you have to be in the market at all times, either long or short, the always in position is whatever your current position is. This is a very important concept, and most traders should trade only in the always in direction. The bar 7 double bottom pullback was sanadakins to get long, hopping for ace condlaga pinto the close. This type of pattern is a spike and channel bull trend. It is useful here because it shows a market transitioning from one-sided trading, a strong trend, to two-sided trading, a trading range. It does not matter if you view bar 3 alone as the spike or the entire sharp move from bars 2 to 4 as the spike. The market pulled back to bar 5 and then rallied in a less urgent fashion. The bars mostly overlapped one another, and a trader could draw a channel that contained prices fairly well. You could also draw a trend channel line across the highs and highlight a wedge type of channel, which is also discussed later. Some traders would have shorted below the low of bar 4 and then scaled in more shorts at other pullbacks as the market moved up. Other traders would wait for the wedge top, where they would take profits on longs or initiate shorts. As soon as the spike is followed by the pullback to bar 5 and then channel type behavior begins to form, traders will see this bull channel as a possible bear flag and expect that the low of the channel will get tested. In small patterns like this one, the test usually is later in the same day, but in larger patterns the test might come a day or two later. The market had the expected two-legged correction from the wedge top to the bottom of the channel, where the bears will take profit on all of their entries. Their earlier entries will be only approximately break-even trades, but their later entries will be profitable. Also, bulls will again look to buy around the low of bar 5 where they bought earlier at the end of the first pullback, and that becomes the start of the channel. The buying by the bulls and by the short covering bears usually results in a bounce. That bounce can be a rally from a double bottom bars 5 and 7 bull flag, or it could be followed by a protracted trading range or even a bear trend. Also notice that the bar 2 low was the third pushdown and therefore a wedge reversal. Bar 6 was a double top bear flag, the first top was the final bar of yesterday, and bars 5 and 7 created a double bottom bull flag. This was followed by the bar 9 double bottom pullback. You could describe the price action between bars 5 and 9 as a triangle that could break out in either direction, but that would overlook the bullishness that the market was showing you. Bar 7 was a wedge bull flag because it was the third pushdown from the bar 6 high. Bar 8 was a final flag reversal after the 6 bar bull flag that preceded it. See